This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
So now we might as well go straight on to question 1. Let me get my paper in front of me. Question 1, and I need to think about Picant, Sander and Adler. Alright. The requirement, prepare the consolidated statement of financial position. I'm not going to write out Part B. I've done the plan for Part B. I'm not going to write that out, so I'll stick strictly to my time allocation. So that's 21 marks for the consolidated statement of financial position. 21 marks is 37.8 minutes. 42 minus 4.2, 37.8 minutes. And the time at the moment is 16:13 down at the bottom of the bottom corner of the screen down there. So 16:37 gives me 16:50 finish. Probably 16:51, yeah, 16:51:62. Okay. Working 1, the structure. Picant acquired 75% of Sander. The 1st of April and the year end in the question is March, so it's a full year. So it's 25% non-controlling interest. And a share for share exchange. In addition, we paid that. And in October, we also acquired 40% of Adler. So we've got an associate company at Adler, and that's 6 months pre, 6 months post. And that will do for working 1. Working 2 is the goodwill calculation. And we've got Picant in Sander and Picant in Adler. And I'm going to do it as a goodwill premium paid on acquisition. I need 3 because I've got a non-controlling interest element. So I've got dollars, net assets, dollars, and NCI. Net assets and dollars. Okay. Market price. A share exchange of 3 shares for every 2 in Sander. So the cost of Picant in Sander is 3 shares for every 2. We acquired 75% of $8,001 shares in Sander, and for every 2 we issued 3, and the market price of our shares was $3.20, so it's $3.20. So 75% of 8,000 divided by 2 times 3. 75% of 8,000 is 6,000. Divided by 2 is 3,000. 3,000 times 3 is 9,000. 9,000 times $3.20 is 28,800. 28,800. Just let me check that. 3 over 2... 4,000, 12,000, 9,000, 27, 28,800, yeah. In addition, we agreed to pay a further amount on the 1st of April, so 1 year on, contingent upon post-acquisition performance of Sander. The date of acquisition, we assessed the fair value of this contingent consideration at 4.2, but by 31st of March it was clear that the actual amount to be paid would be only 2.7. She recorded the share exchange and provided the initial estimate of 4.2. Now the question now is, am I going to put 4.2 million there as contingent consideration? Because we have accounted for that, that's in the liability section of Picant. Or is it an adjustment to an accounting estimate? I'm going to leave it in here as part of the purchase consideration. So I've got 33 million purchase consideration. Net assets at date of acquisition are shares of 8,000. Retained earnings are brought forward of 16,500. Retained earnings this year and it is a full year. Therefore, it's not there at all. So net assets at the date of acquisition 8,000, 16,005. And there always is a fair value adjustment, so I need to consider that. We'll leave the Adler acquisition for the moment. Down in note 1 there. The date of acquisition of fair values of Sanders property, plant and equipment equal to its carrying amount with the exception of the factory. So we've got a fair value adjustment which had a fair value of 2 million above its carrying value. Not adjusted the carrying amount of the factory as a result of the exercise. It requires additional depreciation. Remember that when we're doing working 3. Also, at the date of acquisition, Sander had an intangible asset of 500 for software in its statement of financial position. This has no recoverable value, and so fair value adjustment to the software, that's the factory, that's the software, 500 less. Point number 2, current accounts at the end of the year. Point number 3, non-controlling interest at date of acquisition, we'll do that in a moment. Point number 4, impairment of goodwill. Point number 5, even profit accrual. So we got 24, 25, 26,000. And our share of 26,000 is 75%, which is 19,500. Goodwill is therefore 13,500 attributable to us. NCI share is 25%, which is 6,005. And we're told that the NCI Sanders share price, point number 3, is deemed to be representative of the fair value. So they've got 2,000 shares, and they were worth $4.50 each, so that's 9,000 is the value of their investments. So their goodwill attributable to them is 2,500. And we're also told that there's been an impairment of goodwill. Paragraph 4, there's no impairment of Adler, but there's an impairment of 3.8 million here, and that's allocated on a 75-25 basis. So 75, a quarter of 380 is 950, 3/4 of 380 is therefore 2,850, and that's the impairment. So the NCI is now worth 1,550 and we are worth 10,650. A total value of goodwill of 12,200. For Adler, we acquired 40% of the equity, paying $4 in cash per share acquired and a $100 loan note for every 50. Alright, so we acquired 2,000 shares, that's 40% of 5,000. 2,000 shares at $4 each is 8,000. And we also issued 100. We acquired 2,000 shares, 2,000, up here, 2,000 divided by 50 gives me $100 loan note. So that's 4,000, I think, isn't it? $4,000 worth of loan note, and that has been recorded. So we can actually check now, can't we? Because we've got 33,000 investment there and 12,000 investment there. That's 45,000, and that's what Picant has recorded, 45,000. So we've got 12,000 cost of investment in Adler. Net assets at date of acquisition. Shares in Adler 5,000. No share premium. There was retained earnings brought forward of 15,000 and retained earnings for 6 months of 3,000. Gives me 23,000. It's not likely, there never is normally. No fair value adjustment, so 23,000 as the net assets. Our share of that is 40%, and 40% of 23,000 is 9,002. And that gives me 2,800 goodwill, premium and acquisition in Adler. And that's working 2 done. Working 3, no, I always do that, PUP calculation. There is always a PUP, let's see if there is here. Yes, there is. Point number 2, current account with Sander is 3.4 million debit. This did not agree with the equivalent balance in Sander due to some goods in transit valued. So it's a PUP on the goods in transit. Cost plus profit is selling price. They're invoiced at 1.8 million, but that's not what we're looking at the moment. So all these goods at cost plus 50, so it's a markup. That's 150% therefore. The profit element is a third. So PUP is 1/3 of 1.8 million is 600,000. And this is Picant. So in P, we need to reduce inventory by 600,000 and reduce retained earnings by 600,000. In S, we've got to receive these goods, increase inventory by 1.8 million and increase payables by 1.8 million, and then cancel 3.4 accounts receivable against 3.4 accounts payable. And that deals with point number 3. There's nothing else to do, so we can actually do working 3 now. We've got Picant, Sander, Adler, per the question. Straight from the question we have 27,200. 16.2 plus 11, 17,500 and 21,000. And we've got some adjustments to make. We've got the PUP calculation in P. So we need to reduce P's retained earnings. PUP, goods in transit, reduce P's retained earnings, 600. We've also got the fair value property for the factory. There's a 2 million increase in Sander, but there's fair value property depreciation to come off there. Note number 1, 100,000 needs to come off. And there's a fair value on the no, it has been written off. The software has been written off, so there's no fair value adjustment for that. It's been written off shortly after acquisition. So, I think that puts us into the position where we can sensibly think about adding it up. What we have here. No, we've got also the gain on the contingent consideration. Do you remember? It was anticipated. Paragraph 2, right at the top of the page. The balance is only going to be 2.7. So we've actually made a gain. We need to debit the contingent consideration and credit retained earnings in Picant's books. So that will do for that. So in Picant we now have 27.2, 26.6, 27.28.1. Oh. Okay, I'm going to stop, Chris. I'm going to stop, and I'm going to have to switch off and switch back on again because my computer's fucked up again. I'm not stopping the Camtasia. Okay. So Camtasia presumably can't be recording now because I just switched my computer off, but the other one is recording. Just switching my computer back on now. Hopefully it's been saved. So I've got to go through all this crap again. There it is. Now then, can I write? Yes, I can. So, are you ready? I'm about to start again. Are you ready? I'm going to tap the microphone and then we start. So we can now add up Picant, that's 28,100. And Sander is 19.4 and Adler is 21,000. Take away the pre-acquisition, and the pre-acquisition was in Sander. We've already worked that out, it's up here. Sander pre-acquisition is 16.5 plus the 2 minus the 500, so that's 18,000. So if I take away 18,000 from Sander, Okay, and if I take away, what was it for Adler? Adler was also 18,000. So 18,000 from Adler, therefore gives me post-acquisition of 1,400 and 3,000. And our share is 75% and 40%. 75% of 1,400 is 1050, and for Adler it's 1,200. That gives me 30,350. And if I now take off goodwill impaired since acquisition, and that you'll find in working 2, just our share of the goodwill impairment, which is 2850. $2850 gives me 27,500 on the statement of financial position. Working 4A is the NCI statement of financial position, and they're 25%. So let me tidy that up. 25%. 25% per question. Per question, NCI 25,500. But there have been some adjustments. There have been some fair value adjustments. They're up here. Here they are. 2,000 for the property, 100 for the property depreciation. So plus 2,000 minus 100. So that will then give me 25% times 27,400, and 25% of 27,400. Divide by 4, 6,850. Plus goodwill. That's in working 2. Sorry about this, I've got to keep moving up and down the screen. It's obviously easier if I don't. Their share of goodwill is 1,550. So 1,550. Come on. 1,550. 8,400 is the NCI. Working 5, I've got to do working 5A, the investment in associate. Right, you can do this in 2 ways. The way I prefer is to take our share of net assets, and our share 40% per the question. Net assets are 26,000. So 40% of 26,000 is 10,400, plus the goodwill not yet impaired. Need to go back up again. Goodwill not yet impaired is 2008. So that gives me 2008, 13,200. Now you can do it an alternative way. You can either say, therefore, alternatively, cost was 12,000, wasn't it? And share of post-ac, well, share of post-ac is 40% of a half of this year's profits. So 40% of a half times 6,000, that's 1,200. That gives me 13,200. And then less any goodwill or premium impaired, but of course there is none this time. So it still gives me the 13,200. I prefer this method, but you'll find that when you get to P2, you'll need to use this method. In some situations, not in every situation. And that's it, that's the workings done. And the only thing I must now remember to do is the cancellation of the 3.4 intergroup balance. But we can move down to statement of financial position. ACCA is in working 2, and I've forgotten what the figure was already. So I'm going to have to keep moving backwards and forwards, and it's a pain, but I've got to do it. 12,200 is the ACCA. And then TNCA, from the question, TNCA is 37.5 plus 24.5 plus the 2 fair value adjustment minus the 100. So that's 62, 63, 64, 63,009. Investment, of course, disappears. Current assets, we've got inventory of 10 plus 9, plus there's that 1.8 in transit, but then we've also got minus 0.6, which is the PUP. So that's 19, 20.2. Receivables, again straight from the question, 6.5 plus 1.5, but minus the 3.4. That's 8 minus 3.4 is 4.6. And I think that's it. There's no cash, is there? So that's 70, 80, 90, 99, 100,900. Ooh dear. 100,900. Okay. I don't think I've forgotten anything. Oh, I have. Investment in associate. Working 5A. That was 13,002, wasn't it? 114,100. Okay. Shares. Just the parent company, 25,000. And premium is also just the parent company, that's 19,800. And these have been recorded. Be careful, because if this acquisition has not been recorded by the parent, then some of these shares will have been issued at a premium, valued at $3.20, for instance. So there would have been a premium to account for, but it has been done for us. So shares and premium dealt with. I think I retained earnings, and that's in working 3. I just hope we got that one right. Working 3, retained earnings 27.5, and while I'm there I'll remember 8,004. So 27,005 and 8,004 for the NCI is in working 4A. And that gives me 20, 30, 40, 50, 60, 74, 79, 80,700. And then we've got 7% loan. That's 14.5 plus 2. That's 16.5. 97,200. We've got the contingent consideration, which is 2.7. Other CL is 8.3 plus 7.5 plus 1.8 minus 3.4. That's 15.8, 15, 14, no, 15.8, 16.8, 17.6, 14.2. That gives me 16,900. See how we're doing. 114,100. It should be, it is 114,100. Step-by-step approach. Let's see what time we should have finished. It's 16:36 down there at the moment. What time did I say we should have finished? 16:36. And we should have finished at 16:50. Step by step. Working 1, working 2, working 3, working 4. Okay. So that's question 1 complete. I've not written out, as I said at the start, I'm not going to write out question 1 part B. I've done the plan for it, you've seen the plan for it higher up, so I'm not going to write that out. For one thing, you probably have great difficulty reading my handwriting, which incidentally the ACCA say they do, their markers do on a regular basis, have great difficulty interpreting what students have written. Okay, so that deals with question 1. I'll deal with question 2 in just a minute.